The Nasdaq-listed shares of Rezolve AI PLC, trading under the ticker RZLV, are currently priced at $5.85, marking a sharp decline of 6.87% during today's intraday session as of 12:46 p.m. EST on October 16, 2025. Now, the common expectation when looking at a 6 to 7% drop midday is to assume a fundamental setback or a terrible news release. But the true story here is much more nuanced and fascinating. The stock's recent volatility is less about bad news and more about the market actively attempting to digest and price in a wave of highly aggressive, interconnected acquisitions and an overwhelming increase in institutional interest, particularly in light of their massive $200 million financing round announced just a few weeks ago in late September. This sharp pullback today, where the stock is trading close to its intraday low of $5.05, should be viewed not as a failure, but as a critical psychological test for a stock that has been on a parabolic tear, appreciating over 300% in the last 6 months alone. It suggests that the short-term speculative air is being let out before the market can fully reconcile the company's dramatically repositioned business model. Investors are generally focusing on the headline-grabbing revenue guidance for 2026, which the company has set at an ambitious $500 million annual recurring revenue exit rate, a figure that analysts initially struggled to believe but are now starting to come around to. The common belief is that Rezolve AI is an AI stock pure and simple, benefiting from the sector's broad tailwinds. However, a deeper analysis reveals that the core expectation about RZLV needs to be completely restructured. This company is no longer just a B2B AI software provider for e-commerce. It is systematically constructing a comprehensive AI-powered commerce and payment infrastructure that has profound implications for how retail transactions will occur globally. The key reality that often gets overlooked in the daily price fluctuations is the strategic sequencing of their recent acquisitions. Specifically, SmartPay and Subsquid both completed for a minimal cash outlay of around $10 million plus shares. SmartPay provides over $1 billion in annual digital asset transaction volume, while Subsquid adds a crucial decentralized data infrastructure and blockchain data science capacity. These are not random acquisitions. They are foundational building blocks designed to integrate AI-driven commerce with a proprietary digital asset payment system. The current daily selling pressure and the volume of over 13 million shares traded so far should be seen as a clash between the high expectations set by the guidance and the natural profit-taking and volatility that follows such transformational news and a 300+% run. Let's turn our attention to the immediate price action and the trading volume dynamics, which hold the immediate clues for the next few days. The fact that the stock opened at the previous close of $5.46 and then immediately spiked to an intraday high of $5.75 before the sharp descent to the $5.08 level suggests a significant failed breakout attempt earlier in the session, likely triggering stop-loss orders on the way down and encouraging short sellers. The high trading volume confirms this intense churn. With over 13 million shares traded by midday, the market is aggressively turning over its ownership structure. Crucially, the short interest figures show persistent high short volumes, with off-exchange short volume ratios frequently exceeding 30% and spiking to over 63% on October 15, 2025. This high short interest, combined with a short borrow fee rate hovering near 20%, suggests that a strong contingent of institutional traders are betting heavily against the stock's ability to maintain its September gains. This sets up the classic tension: strong, fundamental-driven optimism from management and supporting analysts versus heavy, technically driven selling pressure from short sellers. This dynamic creates a high volatility environment where $5 appears to be a major psychological and technical support level that must hold to prevent a more significant correction toward the low $4. When we consider the institutional activity, the picture becomes even clearer about the underlying confidence, contrasting sharply with the daily price noise. The institutional ownership has seen a substantial increase, with 95 institutions holding RZLV shares as of the most recent filings, reflecting a significant jump in the number of institutional owners. Firms like BlackRock and Vanguard have initiated or dramatically increased their positions. Specifically, the news about a shareholder transfer of over 10 million shares to a new global institutional investor on October 10, 2025, is a major signal. Institutions do not accumulate this aggressively in a company with a shaky business model. Their buying is a significant counter-narrative to the short-term bearish sentiment driving today's price drop. The institutional confidence is anchored in the company's stated path to profitability, its aggressive gross margin of nearly 96% reported for the first half of 2025, and a raised revenue guidance that analysts like Cantor Fitzgerald and Maxim Group have backed up by boosting their price targets. The market might be selling off today, but the smart institutional capital has recently placed significant long-term bets on this name. Moving to the business model, Rezolve AI provides an AI-first platform for digital commerce, specifically focusing on what they term agentic commerce. In practical terms, this means they offer an AI brain suite designed to address the major headaches for retailers: product discovery and checkout friction. The platform uses multimodal AI, conversational, visual, and text, for product search, and an instant one-tap checkout system that even supports crypto to fiat payments. This positions them as a foundational technology layer, not just an app. Their strength lies in their massive enterprise client list, including major international retailers like Ferrero, H&M, and Urban Outfitters. The recent acquisitions serve to vertically integrate their offering. SmartPay brings payment rail control, eliminating the need for third-party payment processors for digital assets, and Subsquid ensures they control the underlying data infrastructure, which is the lifeblood of any advanced AI system. This vertical integration is what gives them confidence in their high-margin profile and ambitious revenue targets. The contrast between their half-year revenue of $6.3 million, a staggering 426% year-over-year increase, and the net losses remains the core bearish argument. Tremendous growth, but still burning cash. This is the classic Silicon Valley growth at all costs model, now playing out on a public market stage, and it's why the stock is so volatile. Now let's fast forward and analyze what could happen in the next 10 days, a period often characterized by market anticipation between major news cycles. Given the recent flurry of acquisitions, guidance updates, and a massive funding round, the stock is currently in a state of digestion. In the immediate future, within the next week, the technical price action will likely be dominated by two forces. First, the short sellers trying to push the stock below the critical $5 level to trigger more widespread panic selling and cover at lower prices. And second, institutional buyers who view this dip as a buying opportunity to add to their positions before the next significant catalyst. The next 10 days are likely to feature high volatility, probably staying within a tight range of $4.80 on the low end and attempting to recapture the $5.50 level on the high end. A major catalyst is not immediately scheduled, but the market's focus will shift to any corporate announcements detailing the integration progress of SmartPay and Subsquid, both completed for a minimal cash outlay of around $10 million plus shares. Any early tangible results or further comments on the Agentic commerce rollout architecture, which the company outlined on October 8, 2025, could serve as a strong upward impetus. Specifically, if they announce a new major client win that leverages both the AI brain suite and the new payment rail, that would validate the vertical integration strategy and likely force a short squeeze. Conversely, if the broader NASDAQ index suffers from macroeconomic news, Rezolve AI with its high beta of over 2.0 will likely experience an exaggerated move down, potentially testing the $4.50 technical support level. The current trend suggests that the dip is a high-volume capitulation, and if the volume drops off in the next few sessions while the price stabilizes above $5, it would signal the consolidation is over. The long-term outlook beyond the next 10 days is tethered to the successful execution of their highly ambitious 2026 $500 million ARR target. The market is not currently pricing in a clean path to this figure, which is why the stock is trading in the $5 range and not closer to the consensus analyst price target of around $9.67. This disparity, expectations versus price, represents the long-term opportunity. If Rezolve AI can consistently beat revenue expectations over the next 3 quarters, the stock has substantial ground to cover. The company is actively working with massive partners like Microsoft and Google, which provides a strong validation of their underlying technology and distribution potential. The strategic goal is to redefine the commercial infrastructure, making the shopping experience seamless and integrated with emerging financial technologies like digital assets. The ultimate success will be determined by not just the growth in their enterprise customer base, but the utilization rate of their brain commerce and brain checkout products, which needs to be monitored closely in the next quarters, and this is the information stream that will matter. The technical setup shows a significant resistance forming around the $6.50 to $7 mark, which corresponds to the highs seen earlier in October. A breakout above this level would signal a continuation of the bullish trend that began in the spring. For now, the stock is fighting hard at the lower end of its recent trading channel. This high volatility, paired with the intense institutional accumulation and the very public short selling, is characteristic of a stock in a major strategic transition. It's a battle between those focused on the immediate profit and loss statement and those who see the structural change the company is attempting to implement in the retail sector over the next few years. The management's confidence in raising guidance and pursuing non-dilutive foundational acquisitions is a strong signal that they believe the underlying business momentum is accelerating and that the current market price is undervalued relative to their aggressive internal growth projections. To understand the conviction behind this movement, one must look past today's 6.87% drop and focus on the fundamental changes that have occurred in the last 4 weeks alone. The company has essentially bolted on a data and payments platform to its core AI product, massively expanding its total addressable market and control of the value chain.
The final element to consider is the concentration of ownership. While institutional holdings are increasing, the CEO and related entities still hold a substantial percentage of the shares, which can contribute to volatility as large blocks of shares are moved, as was the case with the recent shareholder transfer to a new global institutional investor. This transfer, while technically non-dilutive to the public, shifted a massive number of shares to an entity with a long-term perspective, yet the market initially reacted with a bit of a wobble, highlighting how sensitive this stock is to large volume trades, regardless of their nature. The core question for the market now is whether the high growth rate can be sustained without accelerating cash burn to an unsustainable level. For the moment, the institutional backing and the raised revenue guidance suggest that the growth is manageable, but the next quarter's earnings report will be the true reality check. That is the one event that will determine whether the current dip is a temporary consolidation or the beginning of a larger downward correction. Until then, RZLV remains a high beta stock for high conviction players. Comment below how many shares of Rezolve AI you currently hold, or if you think the market has overreacted to the company's aggressive growth strategy. The conversation around this stock is clearly polarized, and understanding the true drivers requires looking beyond the daily tape and into the sophisticated foundational moves the company is making. The tension between the short-term negative price action and the long-term positive fundamental announcements is what makes this name a compelling